bond ETF is an exchange-traded fund that exclusively focuses on bonds. Let's break this down. A bond is a unit of corporate debt issued by companies and securitized as a tradable asset. Basically, when you buy a bond, you buy a loan, and you make money if the debtor pays you back. A bond ETF is simply a collection of bonds. Instead of buying one loan at a time, you diversify your risk by buying into a basket of them. Bond ETFs have become attractive for one simple reason. It is hard for investors to find bonds with attractive prices. Bond ETFs are a solution as they allow investors to track bond markets with higher liquidity and lower trading costs. Bond ETFs offer the following 3 benefits. 1. Simplified access to bonds. 2. Better price transparency. And 3. Higher liquidity. Let's examine them more closely. First, let's talk about access. The bond market is heavily reliant on individual transactions and prices. When attempting to buy or sell a bond, you must search through a large pool to find a dealer with an appropriate price. This requires that you as the investor hold a certain level of knowledge on how bonds are valued. Does this sound horrible? Yes, well, it is. Bond ETFs take this work out of the process. Rather than having to source bonds from dealers, bond ETFs allow trading directly between buyers and sellers, simplifying the process. Now, let's look at price transparency. Bond ETFs make it so that prices are available publicly throughout the day. These prices are aggregates that enable investors to see the overall trends in prices and therefore make better decisions on when to buy and sell shares. Lastly, bond ETFs provide additional liquidity compared to the bond market. In the traditional over-the-counter market, investors must find a buyer to purchase their bond at an agreed-upon price. Since bond ETFs are listed on an exchange, prices quickly adapt to represent changes in supply and demand. This way, buyers and sellers have more faith in prices and are more easily matched. Bond ETFs have some apparent flaws. No promise of principal repayment, interest rate risk. While traditional bonds promise a payout of the principal over time, bond ETFs do not. For this reason, there is a higher chance of loss associated with bond ETFs. There's a much smaller safety net to fall into compared to a bond's known repayment plan. Second, bond ETFs are more susceptible to interest rate changes. Because bond ETFs do not mature, it is harder to hedge the risk of changing interest rates.